If you guys have been watching what's happening, this last week in Wall Street has been complete and utter chaos. Because the things that you and I talk about all the time, we talk about what is the disruption, what's going on, the uncertainty in the market, money, real estate, investing. Right now, it's Wall Street. Technically, Wall Street, the stock market crashed last week. It lost $6 trillion in value just last week. That's ridiculous. If you had your money tied to anything, your IRA, 401k, retirement accounts, stock, you lost value last week. Period. End of story. That is how that stuff happens. Look, $6 trillion. That is a lot of moolah. Like that is crazy. Like putting that into perspective, $6 trillion worth of value lost in a week. And that comes up with a lot of stuff that I talk about all the time, or I've been talking about with you guys. Where do you want your money? Do you want uncertainty and chaos and craziness in your investments? Or do you just like, hey, I don't want to deal with that? I can tell you who didn't have the uncertainty last week. People who own multifamily real estate. They didn't have that. Now, maybe their tenants did, maybe other people associated with it, but the owners, they did not. Their properties kept on going. At some point next, the beginning of the month, they're still going to collect rent. But I wanted to show this to you guys. So here's what happened. Here's what's going on. This is the actual $6 trillion opportunity in the market, because while they had a major sell-off in Wall Street, that money has got to go somewhere. And if you guys didn't notice, bonds went down. They went down like a little bit. They were sub 4, which that hasn't happened in a long time. They were talking about mortgage rates went down. That hadn't happened in a long time. They were making it like it's this huge deal, like all of a sudden everybody's going to go run to buy a home. That's not going to happen. It didn't go down by that much. Like it's still just a little bit. It's still in the sixes, not high, but it's definitely not to the part to where they were making it like there was going to be this huge gold rush back to single family. That's not going to happen. But this $6 trillion opportunity for real estate. Let me show you what happened though. Here's what happened. We had a crash. This is the opportunity. The market crashed. Wall Street crashed. Period. End of story. There was a crash last week. And a lot of it happened the last 10 minutes on Friday because there was a massive exit of people selling off in the market. There really was. Institutions, investors, that's what happened. The next opportunity, this is what's posing all the opportunities, is Trump. President Trump 2.0. He's disrupting the status quo of everything that's happened by using tariffs, which is the next thing that we're going to talk about. But he's going off and he's making bold claims, big claims. He's fixing one thing and tearing down something else. And unfortunately, that's kind of how the way things work. I'm not saying it's right. I'm not on that path. I don't know what's right or what's wrong, but I know this. Sometimes, let's say there was a big apartment complex or a big shopping center in your neighborhood, in your city. In order for you to build more homes, you have to destroy that old shopping center. Something has to be destroyed so you can bring in something new. Now, it may take a long time before you see the benefits of that, but it does happen, right? So, but this is one of the other opportunities. So here's what happened. Wall Street crashed. Trump came into office and he starts making a huge disruption there. And then right now, the tariffs, my pen, tariffs all across the board, I think is anywhere between 10% across the board. And now all the other countries are like, hey, if you're going to do that to us, we're going to do it to you. And that's having a problem. So the reason why this is a challenge, but it's a benefit, it's an up and down benefit with the uncertainty with the tariffs, is how does this affect real estate? Why does it affect us? Real estate has a lot of different scenarios. So you have Canada, you have China. China is one thing, but you have Mexico, like wood, glass, steel, everything that has everything to do with building a real estate, a multifamily real estate. And we're talking about multifamily. The tariffs affect supply and demand. Bear with me on my paper. That affects supply and demand, period. So if you're a developer, and these big developers, let me show you how real estate actually works. Real estate builders and developers go to institutions, Goldman Sachs, JP Morgan, they'll go to BlackRock, Blackstone, they'll go to anywhere really, like family offices, whatever, and they'll partner with them. That's their equity partners. It's not mom and pops, retail investors like us. It's not the little small business owner. It is pension funds, endowment funds, things like that, sovereign wealth funds. They go there and they'll say, hey, we're going to build something. Now, the challenge is they've already in the process of building. That takes 2 to 3 years to do that. You got to get permits, you got to get approvals, you got to get wherever the site is has to be done. A lot of them have to go to the city, and they got to the lobby, and the city comes around and they say, hey, we'll let you develop and we'll let you build if you'll put in power, if you'll put in a park, if you do this. All that stuff has to happen within that time, right? So during this time, though, no one's going to pull the trigger, even if they already got half of that done. Let's say they already got that done, they're waiting. They aren't going to say, well, look, let's go ahead and build and not know whether lumber is going to cost more, or steel is going to cost more, or glass is going to cost more, or worse, labor. The people who are going to do it is going to cost more. Because right now, Trump installed something where they started tackling people, and people are worried. They're like, dude, what if we get, deported? What like immigration issues? Like, there's a lot of stuff going on in the world right now. So if that's going to affect a developer bringing on more product, more apartment buildings in a market, and if I'm not mistaken, I think it's one unit for every 5 people that are moving to an area. So if there's already a $5 million discrepancy in the amount of housing needed across the United States, this is really just slowing it down. No one's going to pull the trigger if they think, hey, the costs are going to go all the way up on us. We don't know what's going to happen during the next 2 to 3 years while we're building. We aren't going to pull the trigger. Let's wait. And if they have to wait for a year, 2 years before that happens, while the interest rates come down, or while policy changes, or while regulations change, no one's going to play this game. So the tariffs are going to slow up supply and demand. And what does that do? It's going to make existing properties, the rents are going to skyrocket because people are still moving in San Diego. They're still moving into LA. Even though people say they're moving out, people are moving there, period. I mean, don't get it twisted. This is a major hub. California is, I think, the fifth largest economy in the United States, in the world, the fifth largest economy in the world. Only second, I think, to like India, I think it is. Anyways, but why does that matter for real estate? Like I'm saying, because this is the uncertainty in the market. Wall Street crashed, $6 trillion eliminated in a week. Trump 2.0 is still getting after it. His administration is disrupting the pattern of the world right now. Everything went down. Tariffs, it's in question. They're negotiating tool right now, but it's turned into a tariff war between our country and other ones. The goal isn't to make our country the enemy. The goal is to have fair trade. And is that going to happen? We don't know. Tariffs are affecting supply and demand, and that is huge as it relates to for real estate because builders will pause building. Now, the next thing, this is the big one, is the debt. There right now, there's $2.7 trillion in debt. And I want to say roughly, I think it was like 500 billion, closer to 900 billion this year that are maturing. This is matured. That are maturing across the board. Now, this is commercial debt. This is commercial debt, not residential debt. Resident people who bought a home a few years ago, they're fine. Their rates are 2%, 3%, 4%. They're not 6 and 7% where people have to come into the market today as it relates to single family, but commercial debt. This is huge because this is going on with the institutional investors, the big boys, the ones who partner with the big boys. They're sitting on property. And let me show you simply what that looks like. Let's say they bought, most of this debt is 3 to 5 year debt. And it was usually done in a fund. Like we have a real estate fund. So that means that we have very specific timelines that we have to tell our investors we're going to be in. We're long term, 7 to 10 years. But if you're an institutional investor or you're a player that partners with institutions, they got to recycle their money every 3 to 5 years. And they can't get fixed debt. They don't want to lock their debt up because if they have to sell early, which it does happen, and the limited partner, which is their institutional equity partner, the investors, say, hey, we need our money. Something's going on. We need our money, right? They can do that. They can force the hand, right? They don't want to have fixed debt because that fixed debt will cost them more money to sell, right? Stick with me on that, but that's what's happening with the debt stuff. So let's say they bought 2020 in 20, 21, 22, 23, 24, right? So let's say they bought here and their interest rate was 3%. Right in, I would say what? Maybe about this rate, that 3% is now 7 to 9% because they had to get a floating rate, which was called a floating rate on their debt, right? This is happening across the board, but the thing is it didn't happen to the mom and pops. It happened to institutions because their interest rate was really low. But if your rate went from 3% to 9%, that's 3 times. That would mean that your debt payment, your debt service, what's called the debt service ratio or your debt service, which is your monthly payment, your mortgage, your debt payment, is now triple what it was when you started. And if they have an investor that says, hey, look, you have to sell, we need that money back. Why? Because it's pension fund money. It is the state teachers' retirement money. It's the fire department that helped save all those homes in LA. It's their money. They took their money, take a portion of their money as their pension because they were like, hey, we're going to be here, we're going to retire. And then the state invests that money and it invests in real estate, it's the type of real estate that we look at. This is really what happens that they don't talk about. So here's what's going on. This gap right here, this circle right here, in this time, especially if it was a stable asset, you can't account for your payments going up 3 times. And what everyone thought was like right in this area right here, that the rates are going to come down, and they did not. They were like, oh, you know what? It's okay. They're at 7. Let's hold on. So what's going on now is these guys, their investors are like, look, we need our money back. This is happening. It is 2025. I'm going to go to a different page. Stick with me on this. This is important. This is the opportunity here. So now in 2025, 25, all the way to 2027, $2.7 trillion worth of debt is maturing. Now, these assets have to be sold. They have to be sold, period. End of story. They're either need to be refinanced, refi. Now, they were at 3, and they have to refi. Let's say they have to refi at 7% or 6. Let's just say right now they have to refi at 6%. Right. And I know some of you guys out there that do commercial real estate are like, no, the rates are 5.25 and 5.75. You don't know that. You don't know what the requirements are to be able to get that debt, because if they do it again and they refi, they got to refinance for another 3, 5, 7 years. They can't do it for a year. Even if they got a rate cap basically you can pay for. It's like insurance on your interest rate to be able to cap your rate from going up at a certain amount. But that costs money too, and that's expensive. So, and we're talking about billions and billions of dollars worth of debt. We're not talking about a couple $1,000,000 or 100 grand. We're talking about a lot. But if they had to refinance, now the thing is that interest rate brings the pricing of the asset down. It brings the purchase price or the exit price of that property down. This here is the opportunity here, because right now, anybody who has to exit an asset, whether they refinance and it costs too much to refinance, they got to pay their investors back. The CalPERS, the Florida State Pension Fund, the Fire Department Fund, the teachers' pension funds, like anybody who's partnered with these big groups has to pay them back because they got to cycle that money back. They're mandated by law to get that money back by a certain amount of time as a partner. They have to do it. So this is going to happen anyways. This right here, between 2025 now and 2027, this is going to happen, and this is going to be the opportunity. I want to say there's $37 trillion worth of real estate in the U.S., just in the United States. Now, if we could just take over, let's say I won't even say 1%, but less than 1% of that as a group, we can really do great, because this opportunity will not come again for a really long time. The only problems in real estate, unlike the stock, real estate is not like the stock market. The stock market is tied to Wall Street. Real estate is tied to debt. So the only time there's ever a problem in real estate, it is associated with the debt tied to the real estate. It's not the actual real estate itself. Real estate is the security for the debt. So that's the opportunity. I got a bunch of pages written on here that I skipped. Anyways, I'll go back to that. So what does this mean? You want to make a decision here. Real estate versus stocks. And forgot my S. Reason why this is important is because if the stock market lost $6 trillion worth of value, your money's tied to the stock market or Wall Street, whatever it is. All that uncertainty matters. But the thing about real estate is it doesn't have these ebb and flows like the stock market. It's not a piece of paper. Matter of fact, I know we were in Grant's training yesterday, and he was talking about how Ford Motor Company, their shares used to be like $200, and now it's down. We went over the other stock for Beyond Meat. Beyond Meat at some point traded for, I think that's what it was, $200 a share just a few years ago, and now it's $2 a share. You've lost like almost 90% of the value of the stock if you bought that stock back when it was hot. And most of it, if the stock actually goes down, it gets pulled off of the S&P 500 just because they don't want to report it. It stops being a part of the top. And there's only 7 companies on the stock market that's been holding it up, which is the Mag 7 anyways. And they haven't even really been doing that great. They got hit. Tesla got hammered, right? So again, why real estate versus stock? I'm gonna bring this over. It's getting fuzzy, right? So here's why. Number one is real estate preserves capital. That's preserve capital, meaning like you don't have the ebbs and flows of putting, if you put your money in a piece of real estate, it has an address, bricks, steel, stone, glass, people live there, it can be found. It's not like a stock. Everyone woke up last week, everything was great. Everyone's like, oh, what's going to happen? A lot of uncertainty. Boom, their value was gone. One way, shape, or form, if your money was tied to it, it was gone. You don't have that in real estate. It's not that way. And then next, you have cash flow. It needs to cash flow. The cash flow comes from the residents and the tenants. That is, they're the ones doing it. People will always need a place to live, but you don't always have to buy coffee. You don't always need to buy a car. You can Uber, you can rent, you can walk, you can take the bus. Um, you don't always need a hat, right? But you will need a place to live. So even if you bought a stock at a hat company or Nike or you're speculating on AI, all of those things can go down based on some type of information in the market. People can stop. But not the case with real estate. And if it's cash flowing, which it should, you shouldn't invest in something that doesn't cash flow, then you don't have those things to worry about. Next, you get to control. This is huge. Control appreciation. That's appreciation. You get to control the appreciation in real estate. You don't get to control the appreciation in stocks. It just doesn't work that way. So, like in stocks, you can bad headline, stocks can drop. Concern with the problem, stocks can drop. You can have bad R&D in some medical type company or some pharma, big pharma, or something like that has something that comes out that says this kills kids, and all of a sudden that stock plummets. With real estate, I can raise the rents to a certain point. I know that I can raise the rents. If I buy the right location, right asset, and there's jobs moving in, there it's the demographic, the people are not leaving that area. I know at some point, just based on supply and demand, I know I can raise the rents. And because commercial real estate, multifamily real estate is valued based on its income, the income that it generates. That is how I know that if I raise the income by rent or whatever it is that I'm doing, I can control the value of that asset every time. That is exactly how it works. Next, we get the tax advantage. The tax advantage. You get the tax advantages of real estate, right? So let's say you have a piece of real estate, you can write off that. You can write off. You get your depreciation, and let's say you bought a property and you depreciated it. You didn't have to pay money on the money that you made on it because you're a professional real estate person because you spend, I don't know, 750 hours a year on on investing, or you invest in some with someone else like me as a limited partner. We pass the K1 onto you, and you get the benefits of that write off based on that. Or let's say you have a property, you sell that property, and you do what's called a 1031 exchange. It's a like kind exchange or better, meaning like you bought an apartment building, you take the value, the cash, the equity from that you made, and you roll that into the next building that's bigger or better or equal, right? That so then you don't have to pay taxes on that, or you can refinance, take all your money out, your equity that you've forced again, control the appreciation in it, and let's say you made that property worth $1 million more, $10 million more, $20 million more, and you go back to the lender and you can get a refi cash out based on the new NOI or the new increased value of that asset. You can take that out, and that is a non-taxable event because it is illegal to tax debt in this country. So that's another one. What's the other one that I had over here? We had let's see. I did exits, which I just kind of went over that with the exits. So just like in stocks, the only way to exit a stock is to sell it. Now you can go to your bank and you can put your stock up for collateral and you can borrow against it against the margins. But if it goes down, the bank's going to take it. It is collateral. It's not the same thing. And you can't control whether it goes up and down. But with an apartment building, I can refinance it. I can keep it and pull my cash out. I can not sell it. I can bundle up a bunch of other properties. I can scale it with a bunch of other people. There's a lot of other things that I can do as it relates to multiple exits of real estate versus stock. I got to sell it and buy it again. Everyone's like, "Oh, buying the dip." Well, worst case, you sell at the bottom. You take your lumps. You take your loss. You pay your taxes on that gain, and then you try to buy a bunch more, and you're like, "Oh, I got a better position than last time." That just don't make sense to me, man. You got to move out of that. That's a weird thing for me. I'd rather just do the real. I'm only talking about what I've always done. Real estate just to me just makes more sense. Um, and last but not least, I guess I can. You guys can see this. I'll write it right here. So you can scale. You can buy. You can invest money with a group of people. Like for example, we have a fund. So we're doing a deal. Let's say I can have 100 investors in one deal. You can invest with 100 people with less money than you wouldn't be able to go flip a bunch of houses or sell a bunch of products or services for your own business and still come up with the $40 million to get a deal, much less find the deal, fund the deal, manage the management company, put the team together, keep up with the accounting, keep up with the legal, keep up with the investor the platform, all the stuff that you need to make this business work. You can actually just invest in the scale of a real estate, but you can't invest in the scale of stock, right? You can't start a company and go grab a bunch of people's money and then invest it in stock, right? Real estate is the only one that you can actually do that with, to me, as a business owner, to be like, hey, I can go and I can register with the securities and I can set up my company where I can actually help people invest with me with a real asset that cannot be easily taken away or destroyed, like stocks. And then the last one, this is huge, to be generational. Generational wealth. It's generational wealth. I know I jammed these all up, but you can create generational wealth by real estate. The stock, you can do it with stock too. You can pass your stock accounts down and all the other stuff. I don't get into that a lot. I don't know a lot about it because I'm a real estate guy. But the fact is this, I would rather leave my kids real estate. If I pass away, I leave them real estate. They keep that real estate. They still get the cash flow. They still own the asset. They go from there. Whatever it was, that basis that I pass on to them is the basis for where it stays. That's a generational thing for them. And then they can pass it on to their family. They can pass it on to their family. Eventually, that real estate continues to work, continues to pay them, period. It can go on for hundreds of years. The Vatican is one of the largest real estate owners on the planet. And they've been around for, I think, 1,600 years. So real estate is better to do that. There's no stock that's been around for 1,600 years. There's no stock that's been around for some of these the real estate buildings that we see, they're 100 years old, 50 years old, 70 years old, still puking out money every month. There's not a lot of stocks that can say that they've been around that long. Very few. So why stocks versus real estate? Here, this is it. Protect your money. It cash flows. You can control the upside and appreciation. Unlike stocks, you can't do that. You got the major tax advantages. You have multiple exits to be able to play. You can invest at scale in the asset and with other people and not go to prison. And you can create generational wealth for you, your family, and the loved ones. You can leave money to your church. You can leave money to your charities. You can build a hospital or whatever it is that you want to do because you've invested in real estate and it continues to pay you long after you're dead. So that by itself is enough because for everything that is going on right now, like I said, what is the uncertainty? What is the uncertainty for with Wall Street always will create massive opportunities. And where's that at? Just one of those pages? Yeah. The $6 trillion market, the crash of that created $6 trillion worth of lost value in Wall Street, crushed, whatever you want to say, is massive. And with all the things going on in the world right now, this is a great opportunity for either a couple of things that need to happen for you. You either need to learn about investing in real estate or you need to make it to get your money out of the banks, out of your retirement accounts, out of your 401ks, out of your home. Like you've been hearing me say it for the last couple of years. Get your money out of the retirement accounts in the banks. There's going to be a problem at some point. Move your money to real assets. I mean, I talk about all the time. A lot of people went to gold, but if you go to gold, you got to authenticate gold. It's got to pass, it's got to go to somebody. They got to make sure it's good. They got to pass the numbers. They got to do a bunch of stuff. It takes a while. It's not the same thing. And oh, by the way, it doesn't cash flow. It's not like real estate. It doesn't have all the benefits of these things. So, but with the uncertainty going on in Wall Street, with the uncertainty in the stock market, with the crash that just happened, $6 trillion of value lost, real estate investments did not have that punishing experience last week. So just use that alone. You don't need 50, 60-year track record to find out what works. You just need to take a look at what's really happening right now. This will continue to happen, whether it's this administration, whether Trump's gone in 4 years, whether we get a person that's better than him or worse than him. There's going to be something that's going to happen, and it's going to affect your retirement and your investments. And you got to stop doing that. At some point, you want to be like, what do I do to make sure that we create our own economy? That's what I'm trying to do. I'm trying to create my own economy for my family, and I'm going to use real estate to do it, and I want to do it with you guys. So any way that I can help you, I know I bring this information and it seems like doom and gloom, but it shouldn't be. I try to show you. I'm just making a case for real estate. I'm making a case for you to become an investor with me, or I'm making a case for you to become an investor on your own. You could do that two ways. Go to bell-capital.com. You can register to see what we have, or you can schedule a call, talk to somebody on my team or me, and we can answer any questions we have about investing, about how it works. You got to be accredited. You got to have a good attitude. You got to love real estate, and you get to do your own due diligence. That's the beautiful part about it. Or you can go to bell-capital.com/interactive, and you can actually, I'm getting ready to start a coaching group where I just show you exactly what I do. How to find the deals, how to fund the deals, how to raise the money, how to oversee the management company, how to do your own deals, towards that way you can build deals for you and your investors and you and your family, and come up with the level of profit that you want that makes you guys financially free. That's what I really want to do. So it's either invest with me or invest by yourself. Either way, I want to help you. I'm here for you. So go to bell-capital.com. You can invest with us, or bell-capital.com/interactive, and you can join our interactive deal room group, and we go over exactly how to do it. It's weekly calls. I'm here for you. There's an investment. Again, same thing with the other thing. Good attitude. You're a good person, man. Like, I want to build a group of people around me that are interested in being successful. They have more time to create than hate. They just want to win. I want to help you win, and I want to help you and your family win financially. That's really my goal. All right, so I hope this helps you guys. I'm here for you. Give it a thumbs up or give it a thumbs down. Don't be a hater and a hider at the same time. Let me know if this makes sense for you. Let me know if what I said, you had this experience. Did you get rocked last week? I hope not. Or if you're thinking about doing real estate, did this make more sense? You're like, dude, he's right. I see it happening. It's playing out right before my eyes. This is not 2008. This is 2025. It's happening now. People in 2008 didn't know what was happening to them. We get the opportunity to look back and say, oh, wow, this is not the first time. This has happened before. And I'm going to do something. I'm going to make sure this never happens to us again. So I'm here for you. Let me know if you need anything. Let's go. Boom. Are you an accredited investor with $300,000 or more liquid in the bank? I want you to come and partner with me. Look, if you love real estate, passive income, and positive cash flow, appreciation over long periods of time, and you're willing to be patient, come invest with me. Go to bell-capital.com. This is for accredited investors with $300,000 or more in the bank, ready to go. Come invest with me. Go to bell-capital.com.